Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mate.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this interview. There's a lot going on in markets at the moment. We've got the potential for a bubble bursting. There was a lot of headlines about that. We've got earnings season kicking off. We've got plenty of things happening, and we're joined by a guest who has his finger on the pulse and is going to help us understand what's going on.
Finger on the pulse, and for those that came to our live event last year where we spoke about the alcohol industry, this guest absolutely lit up the floor.
Yeah, honestly, Bryce was disappointed afterwards because he was like, this guest stole my thunder.
It is our pleasure to welcome Mark Lamonica to the studio. Mark, welcome.
Thank you. I mean, that's a lot of pressure.
It is.
By the way, that you started off. And I will say that there you gave me beer.
True.
So here, nothing. We were just talking about water, but
true.
It is 8:30 in the morning, but we can run out and get you a beer if you want one.
I'll be okay. We'll see what happens.
So Mark runs the individual investor business at Morningstar and pumps out plenty of really interesting content. And we're going to cover a lot of that today. We're going to be talking about earnings season and what Mark's seeing there. Having a look at the broader market environment as well, because as Ren just said, there's so much happening. And then take a look at a couple of companies that Morningstar have their eyes on as well to unpack what the analysts are thinking around News Corp, Ansell, and ABR Corp. So, and then we'll close out with bold predictions.
Yeah.
Yes.
Yeah.
So let's kick in.
All right, let's do it.
Let's do it. Are you looking to... all right, I'll kick in. So, Mark, we are in the middle of ASX earnings season. Well, at the start of ASX earnings season. We've seen earnings season in the US overseas. But let's start here at home. From the first couple of weeks in Australia, what are you seeing? What have you learned?
Yeah, so the interesting thing, and I'll give a little bit of sort of the Morningstar methodology here. So our analysts are calculating a fair value on every share that we cover. So it's what they believe it's worth. So they create a discounted cash flow model. And we don't have to go through all the detail, but basically they are, like any other analyst, predicting the future. Right. So at the end of the day, as shareholders, we don't really care what happened in the past. It's all about what happens in the future. But of course, the past is the only thing we have to inform what we're going to think about the future, right? So it's one of those things where, like, once earnings are released, it's kind of too late, right? That's already happened, but it informs our analyst models. So basically, if they're surprised, they'll change their fair value. If it's kind of just what they expect, then their fair value stays the same. So it's early in earnings season, but I thought I'd go through a couple fair value changes that they've made.
Yeah.
So REA Group increased it by 7%. So
that company just can't do anything wrong.
Exactly. And we still think it's overvalued, but obviously pretty impressed with what we saw there. Macquarie, so I know that's a stock of the year candidate,
yes.
right?
I'm listening.
Yeah. So we increased our fair value 8% there. And then I think the biggest one so far, and we are early, Grain Corp. We actually raised our fair value by 11%. So
right, okay,
yeah. So that's what we've seen so far, but it is early.
Great. So for people, most people will be familiar with REA and Macquarie. Grain Corp probably less so. Is that just because food prices are so expensive and they'll benefit?
Yeah. I mean, I think, that's part of it. Obviously, we're seeing a lot of inflation, particularly in food. So, and that obviously, if they can pass on those any costs that they have, but pass it on in price rises, then of course, we're going to increase our fair value.
So we're well and truly into earnings season overseas. Does this analysis translate to international markets as well? What are you seeing over there?
Yeah. So, same thing. So we have obviously a team of analysts here in Sydney that that cover Australia, New Zealand shares, and then we've got teams around the world. So we've got a team in the US. US obviously reports quarterly, further along. I think the interesting thing about the US, and I'll talk about a couple of the things that we saw, but, the interesting thing is, the reaction of the market to earnings. And obviously we'll talk about Meta and Amazon. So, we have the biggest drop in market cap, then the biggest gain in market cap. And, more than anything else, like to me, and I think we'll talk about this later, to me, it seems like the market's a little bit jumpy, right? Like, there is nothing, like if we look at Meta, for example, like there is nothing, almost nothing a company can do to report earnings that should cause it to drop close to 25%, right? Like short of them coming out and saying, we think we're going to go bankrupt. So you're seeing a lot of volatility. And I think, if you look at what our analyst did, he lowered his fair value by 1%.
Really? Okay.
Right?
Yeah.
So, and we all know, like I'm sure you guys have talked about, we all know sort of the headlines that Apple's privacy is eating into advertising, that TikTok's taking away, younger social networkers from the networks. But yeah, I think, I personally don't own Meta, but I think if it's something that you're really interested in, it's down 30% this year. Seems like an opportunity, right?
This is something we spoke about on Monday's episode, and it just shows how jumpy the market is. Meta reported 1.93 billion daily active users versus 1.95 billion expectation from market. 2.91 billion, so that was daily, 2.91 million monthly active users versus 2.95 versus expectation. And they had a guidance of 29 billion in rev for Q1 versus 30 billion in rev. So just missing, and off the back of that got slammed 20%, also because of obviously slowing user growth.
No. First time in their history that users dropped. First time ever that daily active users was down. Metaverse costs are, more
blowing out.
Yeah, blowing out. TikTok taking attention, Apple privacy impacting them more than Google in particular. There's a lot of reasons. But Mark, the context here is Bryce and I have a bet. He reckons Meta will break through the $1 trillion mark. I don't think they ever will. So there's a little bit of vested interest here.
It seems like every company is now worth more than $1 trillion, right? So
honestly, Equity Mates is raising at $1 trillion.
There you go. But it's just interesting, right? Like, people are obviously extrapolating these drops like into the future, right? That this is some sort of drop to zero, that they're the new MySpace or something like that. Like, I don't know. You know, the numbers are not that off. So,
that's the thing.
But it's funny. So I'm sure we'll get to this, but it's not just drops on the downside, like Meta. It's also jumps on the upside. Like you mentioned Amazon, but Google, Snapchat. Snapchat was up like 60% in a day.
Yeah, and I think it's the same. I think it's the same thing, right? Like I think the market's very unsure of what's happening, right? And obviously we know everything going on with inflation, what's happened in the past month or during January. And so I think the market's just really jumpy. So I think like anything that they sort of see as good news, they're like piling in. Anything that's perceived as bad news, people are fleeing. So it's a strange environment. Like I think it's just a sign that the market's unsettled.
I kind of love it. It's good for us in the content game, but it's also just good for us as investors. Like this is where opportunity comes.
Oh, absolutely. Like, and you see this all the time, right? If you go back and, I think we'll talk more about the market, but if you go back and look at the market, right? Like it's kind of been a passive investing game since, at the end of the day, since like the GFC, right? Like, and now you're starting to see people start coming out saying that this is a stock picking market, right? And that's what, like, I know personally, when I talk about investing, I'm talking about my own personal investing. Obviously, when I talk about analysts, that's Morningstar, but, I'm trying to find things that are like temporarily undervalued, right? And these environments, it happens. So, Facebook or Meta was not on my list, but if it was, and it dropped 30% in a month, like I would be all over that. So
yeah. So let's take a step back from, I guess, the day-to-day news, the price movements, what companies are reporting, and look at, I guess, the emerging narratives that are coming out of earnings season, both here and overseas. What are we learning about, I guess, the environment more generally from the last couple of months?
Yeah. So, something that we look at a lot at Morningstar, we have this thing called a style box. So basically, this is a 9-box grid that looks at the market from a market capitalization perspective, so big shares to small shares, and then a value to growth perspective. So basically, if you picture those 9 boxes and, look at returns in those boxes. So if we go back 3 months, so small cap growth shares in the US are down 25%. and that was kind of the first fall, and they're down for the year too, if you look at that. But also in the third cap, or in the last 3 months, so mid cap and large cap are down around 18.5%, and value's actually up. And so, I think kind of a narrative that we've seen and that people have obviously talked about a lot is, people are moving away, particularly from sort of tech shares that aren't making money. So you sort of see that, small cap shares, smaller companies are newer companies, they're more risky companies, so they're less stable, don't have the financial capacity. Some larger companies, people are kind of fleeing those, and it'll just be interesting to see if this keeps up, right? It's 3 months, and we can't obviously think that this is a trend yet. I think it needs to be a little bit longer, but this is very different from what's happened since the GFC, where it's been growth has just outperformed. And if you think about it, once again over a 3 month period, the fact that value is up and up a little bit means it's outperforming by 20%, right, in the last 3 months. So I don't know. I think that's kind of interesting, and it'll be interesting to see what happens with that.
Those deep value investors who have had an absolutely miserable time over the last 12 years are now licking their lips.
Yeah, exactly. It's like every once in a while, because the same thing happened like right after the .com crash. Every once in a while, people like bring them out and dust them off, and it's like, go to town, go find some stuff to buy.
It feels like our Twitter feed, all the value investors got very quiet and all the crypto investors got very loud. So hopefully the crypto investors get a bit quieter and the value investors take their place.
Yeah, and I always think it's funny. Like, obviously that's the way the industry works, but as individual investors, we can do both.
Yeah.
So I don't know. I think people feel like they need to go into these camps where I'm a passive investor, I'm an active investor, I'm value, I'm growth. It's like, just you can be all of that. Right? Just look for different opportunities at different times. So yeah.
So before we move on to a bit of a discussion about broader market and the environment, are there any companies that really particularly surprised the Morningstar analysts?
Yeah, honestly, no, I would say no. Like, if you think about, and I know we're going to talk about, sort of our ratings on a couple different shares later. Really what our analysts do is they try to, in isolation, calculate a fair value for a share. And then simply our ratings are just as that price adjusts, right? So, we talked about, obviously, Meta, for example. Like, we think it's pretty undervalued now. We thought it was undervalued before their earnings came out. So, really, I think that the surprises that, I think we should have as investors is overreactions. So both on the up and down. So yeah, I don't think there's nothing profound that our analysts so far have changed the fair value. We talked about stuff. Yeah, there's been 10% changes and things like that, but nothing crazy.
Yeah, there you go. Well, let's touch on the broader market environment because, Bryce and I were on holidays. Hopefully you were on holidays as well, early January, and it seemed like the sky was falling, and we had big investors around the world come out and say that the super bubble was bursting and the sky was falling in.
Which Grantham says all the time.
Yeah.
And I like him. I like reading his stuff, but
He's picked a few bubbles. Well, he's picked the last two big bubbles.
You can always pick a bubble if you're always saying there's a bubble.
Yeah, exactly.
But it feels like the last week or two has been a little bit calmer. But that doesn't mean that everything's okay. So we want to sort of talk, I guess, about what's happening in the broader market. And before this interview, you mentioned you'd been looking at the similarities and differences between today and early 2000s, which was the height of the tech bubble and the subsequent fall. So that obviously piqued our interest. So what have you learned?
Yeah. Well, that was I'm a lot older than you guys.
Not that.
That was my first bear market. So I was in uni actually when that happened. So kind of right at the end of that run up. So, it's something that interests me. And, I do think, at least in my lifetime, and I've looked back and looked at other bear markets as well. But, I do think there are some similarities, as you mentioned, and also differences, which we'll get into. But obviously, the late 90s, as everyone knows, was all about technology, right? So there was sort of this notion out there that, the internet was going to change everything, which it obviously has. But I think the hype around what technology was going to do is it was going to just make us more productive forever. So people were sort of extrapolating out these huge productivity gains forever, right? And, I sit there and look at the internet, and half the time it makes me unproductive. But anyway, that's what people thought, that there was this brighter future. And once again, like this time is different type of argument in anything having to do with the internet, right? Like the classic joke, of course, is pets.com. Somehow that if you sell dog food over the internet, it's, 500 times better than selling dog food out of a store. And, we had the same thing, a lot of speculation. So some of the stuff we're seeing now as we sort of cross from 99. So the market started falling in 2000. So interestingly enough, and obviously I'm not saying anything about it. Interestingly enough, we sort of crossed over. The Fed didn't raise interest rates because they were worried about what would happen in the Y2K problem. Oh, yeah. So they're like, okay, we're not going to raise.
It's so funny looking back and
nothing happened. Yeah. Nothing happened. But they were worried about it. So they weren't going to raise interest rates. And then they started raising in March of 2000. And looks like they're going to start raising in March of this year. And you shouldn't read anything into that. It's just when they meet, right? But anyway, that's sort of when the market peaked. And right before that, we had this huge surge of IPOs. Right. So like all these companies that probably wouldn't have gone public in any other environment, but they're trying to take advantage of this. So we have all these IPOs and, at the end of the day, people wanted tech shares, and sort of Wall Street and Silicon Valley got together and said, all right, you want tech shares? We'll give you some more companies to invest in. And so all this stuff came out and the market peaked March 2000. And then, the S&P went down 49% over the next 2.5 years. NASDAQ went down 79%. And I do think that, when people get very panicked, as you were saying, like in January, I'm looking at your Facebook board. It was like a counseling session, right? And rightfully so. But, I sit there, I'm like, the NASDAQ went down 79%, right? Yeah. That is a drop. S&P, it took 7 years to hit another high. NASDAQ took 15 years. And, the one other thing that I think is kind of interesting that's happened recently also is there was this huge surge of investor money, individual investor money going into the market. So 2000, the year it started dropping, that was when there was this huge surge. So 260 billion went into U.S. equity funds that year, and that was up from 176 billion in 1999. And what was this? This was buying the dip. At the end of the day, right? The market started falling in March, and the market doesn't fall. It fell for 2.5 years, but as it started going down, people started doubling down, right? Yeah. Like this whole buy the dip mentality, which I think happened a lot in January as well. And, the interesting thing is the insiders, so all these new tech companies that had gone public, they were all selling. So they sold 23 times more shares than they bought. So it was just an interesting environment. And, if we look at what's happened, right, we've kind of seen the same thing, right? And I'm not saying that this is going to happen, and I certainly don't want it to happen, but we started seeing in the risky parts of the market, right? Small cap technology shares, it's starting to get bigger, right? Up into mid caps, large caps. So I think that part is interesting. The other thing that's interesting is in 2000, so when the market started falling, the Wilshire Large Cap Value Index went up 17%. And as you guys know, right, the problem is that with a market cap weighted index, after years of certain shares outperforming, they make up a lot of the index, right? So the average share could go up, but the indexes go down. And that's where I'm interested to see if the market continues to go down, what happens now, because 50% of the market's passive now. And it was 15% back in 99, 2000. And so what are these passive investors going to do? And they will drive it lower or keep it. I mean, it'll be interesting.
As long as Apple, Microsoft, and Amazon keep going from strength to strength, we could have a full-blown recession, and passive investors would go okay.
And that's the thing. Like, I think a lot of people, are like, oh, I invest passively. I'm not making, any sort of bet on anything. I'm like, well, you kind of are right now, right? You're betting on Apple, a company that has a market cap bigger than all the shares in Australia combined,
Yeah.
right? Like that's what you're betting on.
I'm surprised a ETF provider hasn't done like an S&P 500 X FANG ETF to give you like some exposure to the other 495 companies there.
There's an equal weighted one. So that like
In Australia?
I think Beta Shares has an equal weighted product.
Yeah, I think
I'm forgetting
do
the
they?
ticker.
Okay.
Yeah.
But so there you go, right?
There you go.
The 500
Yeah.
largest shares, the same weighting as Apple.
Yeah.
It's interesting. So it would just be interesting to see what these passive investors do because, and I do both, right? So I own some passive ETFs, I own individual shares. But when you own individual shares, like, and maybe I'm being naive here, but if you understand the company, you can see drops as opportunities. You could hold on because you're thinking of it as a business. I just wonder how maybe some of the newer investors who are investing passively that think the market just goes up, is there anything to hold on to? Or are they going to get spooked at a certain point?
I think that would be the biggest shame if all of these retail investors got burnt and stopped investing. Like that would be...
Well, it's on us to make sure that doesn't happen.
And just for people who want to learn more about the equal weighted ETF, its ticker is QUS.
Yes.
So they can Google that and do their own research.
Yeah. Very interesting. I mean, we've experienced the S&P drop 30%, but that happened in about 6 days, and then it went back not 2.5 years.
Yeah.
So that's the part that I'm really interested in. Hopefully don't have to experience it, but what happens if it's drawn out over an incredibly long period of time? And that brings us to chatting about psychology, investor psychology. So one of the big similarities between sort of the 2000s and what feels like now is that rampant speculation, which you mentioned, a lot of retail investors just throwing cash in. In 2000, it was the internet companies, which you spoke about, but now it's that crypto, Web3, everything that Ren's getting into, metaverse.
So we're talking about you.
All those projects. He keeps complaining he has no cash. It's all sunk in Web3. So how do you think about the differences and similarities in investor psychology around these times?
Yeah, I mean, I think it's ultimately the same thing. And it has been, every bubble, if this is a bubble, we'll find out. You can only find out after, right? But like every one of these runs in history, if it was the tulip, mania, the South Sea bubble, like it's the same investor psychology. It's just sort of different tools, right? So you guys named a couple things, which I agree with, but also just the leverage in the market, right? It's so easy. So whether it's borrowing money or options or there's just a lot of other ways that you can speculate, and we all just follow patterns, right? That's how humans act. We just follow patterns. And what have you been taught, other than obviously that very quick COVID fall? What have you been taught since the GFC? That
stocks only go up.
Exactly, right? So there you go. I mean, it's understandable.
Yeah. I think the big thing thinking about the 2000 internet bubble was that a lot of the theses weren't wrong, they were just early. Like, I don't know if you guys have read The Hard Thing About Hard Things by Ben Horowitz.
I haven't. But
So the Andreessen Horowitz, the VC firm, he was a CEO in the 2000s of a cloud computing company that ultimately got bought for far less than they raised at. But cloud computing wasn't wrong, it was just early. And similarly, we mentioned and laugh about pets.com, but selling pet food and pet supplies online wasn't wrong. It was just early. Like Pet Circle and stuff are doing it these days. Zoo Plus over in Germany. And I feel like that's what we're going to learn in this recent thing. Like Web3, Metaverse, there will be some things in there. But the challenge will be like, are we just too early?
Yeah.
Like, is the technology there and is the business models there?
And that's I think it's the interesting thing about being an investor, right? That like, in my opinion, you go back and you look at certain points in history and you can see that, things that change the world don't necessarily make good investments. And I think people think that there's like this direct correlation between like, hey, electric vehicles are going to take off. So anything having to do with batteries, any car maker with an electric vehicle is, going to be amazing. But it just hasn't happened. Like, and I do a podcast as well with a colleague of mine, and she's much younger, so she's 28. I'm 42, and so she's got this little "you're an old man" thing every time I talk about this stuff. But like, even if you go back and you look at like the railroads, right? Like at the end of the day, so the railroads changed the world. We don't appreciate it as much now, right? But you go back and look at the railroads; they were terrible investments because all this money poured into it. Every single railroad, like everyone and their mother started a railroad company. There's all this capacity, and their ability to charge people just, fell through the floor. And it turned out to be a terrible investment, but it still changed the world. And at some point, it made a lot of sense, right? So, I think it's early and realizing there isn't that direct correlation sometimes between growth and actually being a good investment.
Well, Buffett has that quote about like, if a capitalist had been at Kitty Hawk, he would have shot the Wright brothers down or something like that, because like no one's made money on airlines in the however long they've been around.
No, exactly. Some things that are used a lot are just not good investments.
So Mark, we want to get to stock specific stuff, but one more thing I guess on the broader market environment was when we were talking before this interview, you mentioned you had some thoughts on the democratization of investing and that whole narrative and what that means. So talk us through this. What are your thoughts? Is it all spin, or what do you think the result will be?
Yeah, I mean, I don't think it's new, right? I think it's one of those things that people keep talking about like this is a new thing. Obviously, this Robinhood effect, right? At the end of the day, that I can sit there and now, like, what has happened? We've broken down barriers in investing. We've removed friction, which are fees, right? So now you can trade free in a lot of situations, especially in the U.S. And now, you can trade from your phone, so you can stand in line at the movies and, trade options. Not sure if that's healthy, but anyway.
I think one thing I'm thankful for in Australia is that you can't do that. Well, it's harder to do.
Yeah. And I think that's a good thing. So that's been democratization this time. If we go back to 2000, like it was online trading. And I don't think people appreciate, once again, this is the old man in me, me sitting in my uni dorm room, being able to trade on my computer was a completely revolutionary thing because you used to have to call a broker. And so if you think about like the friction involved in that, like I had to call a broker and talk to the broker, and then he or she had to put in the order, and and you paid a lot more for that. So like that was a huge step in democratizing investing. And it also removed, and just as you said, right, sometimes when you remove this friction, it's a bad thing, right? Because if I call my broker and I want to put all of my money in some like call option on some very speculative investment, he or she could talk me out of it, right? But I don't have to do that anymore. Now I could do that in 2000, I can do it on my computer. Now I can do it on my phone, and I can trade options, and I can do all this different stuff. It's sometimes not a great thing, right? When I want to sell, there was somebody to stop me. I could call my broker and say, do you really want to do that? I know you're panicking. The market's going down, but think about it. Call me tomorrow. Take some time. Now there's nobody, right? Like I can sit there, see the market falling on my phone, just sell everything I have if I get scared. So I mean, it's interesting. We'll see, sort of see how the whole thing plays out.
Interesting. Maybe we should just set up a hotline.
Exactly.
Should I do it?
Or like a Google Chrome plugin that when you go onto a broker website, we pop
up. Don't do it.
So you don't actually want people to call your actual numbers. This is not where you're going to give away your mobile numbers.
No.
What we'll do is we'll put Mark's number in the show notes.
I give out. So the interesting thing is, your podcast is a lot more popular than the one that Shawnee and I are on. But I put my email address in the show notes. So if you go to Investing Compass, you want to email me, my there you go.
Bump it up and put your mobile number as well.
Exactly.
Well, we'll go one step further and put our home addresses there.
There we go. All right. See, that is democratizing investing. If somebody doesn't like what you said, they can come to your house and tell you in person.
So, Mark, at the top of the show, you mentioned that Morningstar has a pretty comprehensive team of analysts, and you pump out a lot of research on ASX-listed companies and then companies from around the world. And we've pulled out a few here to go through to really sort of unpack. And we start with one of Equity Mate's major competitors, and that is News Corp. News Corp you've rated as 2 stars, no moat, and they're trading at a 30% premium to fair value. So it was a pretty scathing assessment of news. And we want to hear the key reasons for this.
Yeah, we would call it an unbiased look at the underlying value of the company. But yeah, listen, at the end of the day, we talked about this earlier, what we are trying to do. So we do have star ratings, so 5-star shares that we think there's a biggest discount between fair value and what it's trading for. And 1 star, of course, is the opposite, most overvalued. So if we said they're News Corp, we're looking at overvalued, right? And as you said, pretty overvalued, but that's just simply a price mechanism, right? So we think the market is overvaluing it. There are things that we like about it. There are certainly things we don't like about it. I think, News Corp, like so many of these companies, is obviously going through a transition, right? So like you guys are not going from a transition from the Equity Mates newspaper to digital way of engaging with people. Yeah. And, I think there's a lot of risks associated with that. And opportunities as well, but yeah, I think that's kind of the take our analysts have on it.
On that point, the internal disruption at News, it's pretty interesting to watch. They're definitely late to the streaming party, but going from a Foxtel focused business to a Binge and KO, and they have a news streaming Flash.
Yeah.
Don't think that's going to do well.
Why would you? Yeah. Anyway.
What's the Morningstar analyst take on the internal disruption? Are like a News Corp going to be a streaming giant?
Yeah. Streaming. Everybody's streaming, right? Like it's one of the interesting things. And I know it doesn't sound like this, but I prepared for this today by listening to a couple of your latest podcasts. So I listened to your bold predictions actually on my walk over here.
Nice.
So I know you
thoughts and feelings.
Well, yeah, there was a bold prediction around streaming, right? Like in consolidation. So I think it will be interesting to see what happens. Yeah. We've gotten into this situation, right? Like, and if we talk about moats, and obviously we'll spend some more time talking about moats or sustainable competitive advantages. What is it in streaming? Well, it's content, right? It's like, what is the content you actually have? And, I don't know about you guys, but I've got 2 different, what do I have? I have Netflix and Stan. And I don't really know why I actually picked those. I think my wife did. But anyway, it's about content. That's why you're making those decisions. And you guys talked about Amazon and MGM and like, how do you get this content? Netflix has spent a ton of money making their own content. And that's not great for business, right? Like if that's the way that all of these, I think it's an industry that does need to consolidate. Because, everyone out there spending a ton of money on content is not good for investors. Yeah. Right? Like that means that there isn't a moat. They don't have a sustainable competitive advantage because they have to go out there and spend all this money. So, yeah, I think the question is, we think that they've made some good gains in streaming. But they've also, if you looked at their earnings, they've also sort of fallen off lately, right? Like we've seen this we saw this in Netflix, right? We saw this huge drop in Netflix because people are emerging from their homes again, right? And going out and doing actual activities instead of watching TV. So yeah, it'll be interesting. It'll be interesting to see who the winners and losers are. Like we think that they're decently positioned, but that maybe this isn't a great business overall because of all this competition. You need consolidation.
Well, they don't even have a narrow moat. You've said no moat. So.
No moat. Exactly.
Tough to be in News Corp.
The best thing about News Corp is that they're a majority owner of a good business in REA Group.
Yeah. No, they are. And, the interesting thing is, what is that? And so, we obviously in our analyst report, we sort of broke that down. And so around 20% of their earnings come from REA at this point, but still 29% come from sort of their print old school, newspapers.
Really, 29%.
Yeah, 29%. So, and that's obviously not a great business. And so I think the interesting thing, it'll be that transition, right? So like, they need to make up for that revenue because that will keep dropping. And I think it's hard. I guess I would say these are hard companies to invest in because there's so many moving parts and you're trying to figure out, okay, what's going to happen to this old legacy business? Is the new growth business? And, we've seen, I know we talked about Netflix, and Netflix hasn't done well, but, that's that transformation Netflix went through, right? Where, they were still making money. And once again, my old man stories, like I used to get the DVDs delivered to me, and they were still making money off of that. And they decided to like burn down that part of the business so that they could focus. And yeah, I mean, that obviously worked out pretty well.
Yeah,
but, we'll see what happens with News Corp.
So, Mark, we'll move on from News Corp to the next company we chose was Ansell. And the reason we chose that was it was the most recent company that had been given 5 stars. Only a narrow moat, according to the Morningstar analyst, 26% discount to fair value. So talk us through it. What are the reasons for 5 stars? And people may not be familiar with the transformation Ansell went through the last couple of years. So maybe just explain.
They also might not be familiar with what they actually do.
Yeah, they make gloves.
Yeah.
Right? Like not the world's
They
most
did
exciting.
make condoms.
Yeah, well, that was the transformation I was referencing.
Oh, sorry.
Yeah.
Sorry.
Both rubber products,
Exactly.
but just different rubber.
Yeah. So yeah, they make gloves for like industrial uses and healthcare uses.
Yeah.
And yeah, leaving all the jokes aside. So yeah, once again, what's happened is the share price has dropped a lot. So how have they gotten to 5 stars? That share price has really come off.
Okay.
So it's down 40% since July of 2021. And really, it's coming down because of margin compression. And when we think about great companies, what do we want? We want big margins at the end of the day, right? So that every dollar they sell, they get to keep more. And a couple things have happened. So number one, labor costs have gone up, freight costs have gone up, and then input costs have gone up. So, right, you make rubber gloves out of a byproduct of oil, and oil's gone up a lot.
Yeah, okay.
And our analyst basically thinks that this is temporary. So, at the end of the day, and that's why the fair value hasn't dropped, right? Because we are looking into the future. So their margins dropped from like 40% to around 35, 36%. And we think it's going to reverse. So our analyst thinks that, in the next couple of years, we'll get back up to 39%. They'll pass on some of those costs to consumers. We'll see the labor market not keep accelerating. So yeah, that's sort of the story.
It's pretty crazy that a 3 percentage point drop in margin can translate to a 40% drop in share price.
Yeah. Well, hey, I mean, we just talked about Facebook, right?
Yeah,
it's pretty crazy that losing a couple active users equals whatever billions, coming off.
Yeah, the other thing about Ansell is, this should be its moment. The world is in a healthcare crisis. The demand for their products will probably never be higher in terms of, the world being focused on, getting these products to hospitals and to everything. You don't like to see the fact that they're 40% down in a moment like this.
Yeah, and I think the interesting thing is, in the June quarter or the June reporting period, they grew earnings. So their earnings are growing, but their margin dropped. So their earnings before interest and taxes margin, EBIT margin, dropped 25%.
Okay.
So, we had this big drop. And yeah, I think investors got spooked, right? And margin's really important.
Yeah.
Yeah.
So to close out, Mark, we've got ARB Corp, ARB Corp. It's 1 star, narrow moat, and an 89% premium to fair value. And a reminder for those that don't know what ARB Corp is, they make four-wheel drive accessories.
Yeah, and one of the most hyped stocks, I reckon, of last year. So I was surprised to see it get 1 star. So.
Yeah. So once again, we think it's a good company. I will say that. So, these star ratings, once again, our analyst doesn't set them. It's just based. We think it's really overvalued.
Yeah. Okay.
But we do think it's a good company. Obviously, it gets this narrow moat rating. We do think it has sustainable competitive advantage. We just think it's trading for a lot, right? So it's trading for, even if we look, 30 times forward earnings, right? And Google's at 24. So, I think, and obviously very different industries. We shouldn't compare them, but still, just a little perspective.
Wouldn't
right?
be surprised if Google is somehow in four-wheel drive accessories somewhere.
Yeah, exactly.
Yeah, part of their self-driving car division.
So yeah, I think that's the only, it's been this market darling. We just think it's overpriced.
Yeah,
It's not that we don't think it's a good company. So
yeah, I imagine if we had done the work and looked at a lot of the really hyped stocks, they would probably have low star ratings just as the nature of the value.
yeah. It's just sort of the approach that we take, right? So like our analysts they ignore price movements. I will say that there are some analysts that obviously keep an eye on what's happening and don't want to sit there and say something's 89% overvalued, and they'll just sort of inch that up. But yeah, we try to keep that completely separate.
Do you want to name and shame anyone?
No, I'm just saying that there are some more. We don't have an investment banking business, for example. There's no incentive for us. So.
Okay. Just wait until Mark starts the investment banking business at Morningstar.
Yeah, exactly.
Then the ratings will change.
Maybe a project for this afternoon.
Everything suddenly has 5 stars.
Yeah, exactly.
So, Mark, before we get to the final 3 questions, we love a bold prediction here at Equity Mates. You said you listened to our bold prediction episode before joining us today. So, we want to close out this episode by asking you if you have any bold predictions for the year ahead.
Yeah, it was interesting. I listened to it on the walk over, and I was thinking, because I already had in my head that you guys were going to ask me this. So, I was kind of trying to think what mine was, and walking over, I was like, wow, your bold predictions are a lot bolder than mine are.
You got to go big.
That's how I do.
You gotta go big.
Yeah. So
and we never are right. That's the other thing.
So maybe I should have been more creative. But we do this on our podcast, Investing Compass. We do this like twice yearly. Shawnee and I sit down, do this twice yearly, like portfolio checkup, right? We kind of want to be transparent about what we are doing. And I will say that, over the past couple years, I have been building up cash, and I haven't been selling anything, but I turned off dividend reinvestment plans. Once again, these are my personal investments. I turned off dividend reinvestment plans. New contributions I make into my accounts are just sitting in cash. And so I'm up to the point now where I'm at 25% cash. Wow. And there's also been a lot of things I've owned that have been bought out. So all this stuff that we hear about in Australia, seemingly I own everything that's been bought. So, but yeah, so I've built up this cash, and kind of every time we do one of these episodes, I say the same thing. I'm still looking for opportunities. And I think this year, so my bold prediction, which is really about me, is that I'm going to exit the year at less than 5% cash. So
Nice.
I think not necessarily that the market will crater, although I think that could happen, but I think that this volatility that we talked about is going to create a lot of opportunities, which I'm excited about.
Nice.
So yeah, that's my bold prediction. It's not Twitter's getting acquired and things like that.
I do like that one.
I do too. But yeah, that was my not so bold prediction.
Nice. Well, a prediction that's entirely in your control.
Yeah.
I know, exactly. Yeah.
We get Mark on at the end of the year, the day before.
Yeah, he's like, bye.
Drains his brokerage account, goes on a shopping spree.
Yeah, exactly. I'm trying to assume that I will do something rational, but you never know.
Yeah. So before we move to the final 3, you mentioned there that everything you own seems to get acquired. You're the acquisition whisperer. We need to come up with a better nickname than that. But do you own Peloton?
I do not.
Okay.
I do not.
All right, so no acquisition on the horizon.
It's mainly it's interesting because as you can probably tell from my accent, I am American, and most of my assets are still in the U.S. But it's really this Australian. Like I've started investing in Australia. I've been here 7.5 years. I'm a citizen. I'm not going anywhere. But it seems seemingly everything in Australia that I own has been bought. Bingo and Sydney Airport and
Afterpay?
Not Afterpay.
Okay.
Not Afterpay. But yeah, it's just, I don't know. It's just been this weird situation, right? We're seeing all this stuff get purchased, which I guess is good.
Yeah.
What do you do with the money?
Keep it.
Yeah, no, I'm not giving it away.
Put it in cash.
Yeah.
Now, Mark, it's been an absolute pleasure having you on. This episode hasn't been sponsored by Morningstar, but if people are interested in what you're talking about and getting access to the analysts and the coverage that you do, or want to follow you, what's the best place to do so?
Yeah, so we do a couple different things. So we do have a paid subscription product called Morningstar Investor. We just rebranded that. It used to be Morningstar Premium. And yeah, that gives you access to our research. So it's 1,600 shares globally that our analysts cover, around 200 in Australia and New Zealand, and then 450 ETFs, funds, and bunch of tools. So you get a free subscription to ShareSite, their investor plan. So there's a lot involved in that. But also we have a bunch of free stuff too. So, I will say that, I'm pretty passionate about financial literacy, investor education, as I know you guys are as well. And so, we've got a podcast, Investing Compass. I do 2 webinars a week that are free.
2 webinars a week.
Yeah,
Jeez.
Tuesday, Thursday. So I got to do one later. Got to do
My
one later
inbox is
today.
full of Mark and Lamonica. La, la, la.
Yeah. So I do 2 webinars a week. So we've got a bunch of great content that we put out on our website as well. So that our editorial team puts together. So for
Awesome.
anyone, hopefully we have resources to help you be a better investor.
Yeah.
Nice.
Well, as Bryce said, this episode wasn't sponsored, but maybe the next one should be.
Okay. So we can we'll talk about that.
Nice one. Well, Mark, we really appreciate you taking the time today. I think Bryce put the challenge up early by saying you were the star of the live show we did last year, and I think you've well and truly delivered.
Well, that's good.
Yeah. So we'll have to get you back before the end of the year to figure out how much cash you're holding.
Yes.
But before then, we'll get into the final 3 questions. The first one is, do you have any books that you consider must read?
Yeah, there's obviously a lot of them, but the one that probably struck me the most. So Jeremy Siegel is a professor at the University of Pennsylvania, the Wharton School in the U.S., and he wrote this book called The Future for Investors. And it's funny, I'm not that big of a nerd, but I remember where I read the book. I was sitting on this lake in Maine, up on vacation, and for some reason, what he was talking about just clicked, right? I think the thing with investing is there's lots of different ways to do it successfully. There's lots of different ways to make money, but you need to find what works for you, right? Because that's the only way you'll keep at it, when there's volatility. And what resonated with me is he was just talking about expectations, and that investing is, and the results that companies deliver from an investment standpoint are really just compared to what those expectations are. And it's this concept that things are priced into shares, right? And, if you've got a company, if you are Tesla, right? And the expectations of the investors in Tesla are, at this point, potentially they're going to sell half the cars in the world in 10 years, right? The expectations are so high that the way they'll be judged and the way that share price will perform will be based on how it does compared to those expectations, not in an absolute basis, right? So it's one of those things where you can do very well on an absolute basis, but if it's priced into the share, you're not going to do well from an investing perspective. And so, I don't know, that really resonated with me. And so, what I always try to do when I look at a share, I'm like, what does the market think's going to happen? And sometimes it's a company that the market thinks is going to do terrible, and it just does a little less terrible, and it's actually a decent investment. So, I just think that that's interesting.
That's
Nice
good.
one.
Yeah,
Good
that.
recommendation. Second question. What is the best company you've ever come across?
Okay, I feel like I have a good one for you guys here. So, I didn't want to do anything, too boring here. But I'm going to go with Philip Morris International.
Yeah,
Okay.
Yeah,
All right.
yeah.
So,
Controversial, but
yeah,
good pick.
yeah. So the ESG crowd is probably gathering with torches. I don't know if there's a back entrance to your studio, but so Philip Morris International makes and sells cigarettes. And the question you asked was not what is the most ethical company in the world, but what is the best company.
Yeah.
And I just want to talk about it because I think to me, this is what we should look at in shares. So, number one, what is the company, or what do we want to look for in a company? There's obviously, they sell goods, right? Every company sells a good or service. That's important. They want to grow those. There's the margin, right? How much do they get to keep? So that's really important. And then finally, we have money that's invested in the company, not your money, the company's money, right? So money that they generate through free cash flow, money they borrow, money they raise in equity markets. What return do they get on that? And Philip Morris is off the charts, right? So if we look at margin, and there's all sorts of different margins we can use, but if we just use, gross margin, right? So that's sales and cost of goods sold, right? So theirs is 65%. So, right, the S&P 500 is at 40%. Google, which is outstanding, is at 56%.
Wow.
So it's just crazy, right, that they keep a lot of money. Then there's this return on invested capital, right? So what return are they getting on what they invest in the company? It's over 50%, which is unheard of, right? And the S&P 500 is 8%, and Google 16%. And, we've got a wide moat rating on it, and, Why is it a wide moat? Well, number one, their product's addictive. That helps. But also just like they've got this brand, Marlboro, that nobody can do anything about now because there's no advertising. Nobody's starting new cigarette companies. And they've got really great cost. So they have driven down costs so much that, and I don't even know what a package of cigarette costs right now to buy, but they make a package of cigarettes for 47 cents US.
Wow.
Bryce, you know what a deck of darts costs?
No.
So,
I actually have no idea.
yeah, so you may not, listen, from an ESG perspective, you may not want to invest in it, but yeah, it's a great company. From an operation standpoint.
Isn't Philip Morris also known as the best investment of the last 100 years or something?
It is. I didn't want to mention it twice, but it's in that Jeremy Siegel book.
Okay.
And he's talking about low expectations because of obviously everything going on in tobacco. Yeah,
there you
I just
go.
didn't want to keep talking about it. I think people I was obsessed with Philip Morris.
Well, everyone should go and read that book and not buy cigarettes, but look at the story of Philip Morris because it is a fascinating one. But final question, Mark, if you think back to your younger self, maybe sitting out on that lake in Maine, trying to learn about investing, what advice would you have for your younger self?
Yeah, so, kind of quickly, I was thinking you guys were going to ask me, what was my first investment ever?
We normally
we do,
but we had
yeah.
so much to cover.
Yeah,
we cut
yeah.
it.
So
you can tell us right now.
Well, no,
if you
it's kind of part of that. So it's two different investments. So number one, during the .com bubble, me sitting in my uni dorm room, I bought Global Crossing. Right, so Global Crossing is a company that went bankrupt, so there's the end of the story. But basically, the internet's blowing up. Everyone's going to use the internet. It's going to change the world. So this is a theme, a narrative. And what did Global Crossing do? They built the infrastructure for that, right? They laid all the cables and everything else that supported internet. So I thought, this is a perfect investment, right? This is the best thing to do. Well, what I didn't do was any homework to realize that ton of money flowed into that space. They had all these competitors and they laid all of this cable. And, I think when the company went out of business, of all the cable that was laid in the world, 5-6% of it was being used. Wow. And this glut actually led to a lot of the companies that have done really well now, right? The fact that you could deliver content over the internet cheaply was because there was this glut, right? So if we think about YouTube and Facebook and Netflix and all of these companies, it was because of all this investment. But it was a terrible, terrible decision from an investment perspective because it went out of business. And then my wife was given shares when she was 2 years old. So the oldest thing that we own was purchased, not obviously by her, but in 1981. So, it's 40 years old, 41 years old, and I'm 42 years old, so it's almost as old as me. And so it's ADP. So ADP is a company where basically you outsource, payroll and things like that. And so, I went and looked in my account to see what this is. So yeah, we've got a cost basis on those shares of $1.12. It was trading at $208 yesterday, and it's paying $4.16 in dividends per year.
Yeah, wow.
So 4 times what the cost basis is. And so I think, the lesson is that being an investor, think long term, and, let those, and we have a wide moat on it, let your investments accrue over time and compound over time, and that sometimes the story out there, this narrative that makes a lot of sense maybe on the surface, isn't a great investment. So dig a little deeper.
Yeah.
Wow.
I think that's great advice.
Yeah, love that. Great way to finish. And Mark, as Ren said, you've absolutely delivered on the high expectations that we set. As investors, we set really high expectations for your future performance on our podcast. So
Okay, well, that is good. That is good.
No, I loved it. And I think our audience would have taken a lot of value from that. And, certainly we'll be helping them understand what's happening in markets at the moment and hopefully make them feel a little bit more comfortable about the volatility that we're seeing. So thank you very much. Absolute pleasure.
Awesome. Thank you, guys. It's been fun.
Equity line.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.